And how can a super fund provide retirement income? Well, there's two ways. I mean, you can get a transition to retirement. You set up a transition to retirement account if you're over 60. So the government does set up this process. Once you're over a certain age, that you can start withdrawing money over 60. It's tax-free, and it's designed so you can sort of move yourself into retirement slowly. If you can take a small amount of money out of your pension fund as a regular income, you can perhaps go to part-time working. The other one that a lot of people forget about is you can go to an allocated pension. And an allocated pension provides effectively tax-free income. So if you think about how you've accumulated money in your super fund, it's typically taxed at 10 to 15% on any income or capital gains. So 15% on income, 10 to 15% on capital gains. Once you move to an allocated pension, it's all tax-free. So if you've got Commonwealth Bank shares in there that you've held for the last 20 years and there's a huge capital gain, once you move them to an allocated pension portion, you can then sell some of your Commonwealth Bank shares without triggering any capital gain. There's no tax to pay. So there's a 10% tax saving if you've held those shares for a number of years. Any income you earn, like dividends on Commonwealth Bank shares or BHP, they are tax-free in your hands, and you get a cash rebate for the franking credits. So it's a very generous system if you moved from your retirement accumulation process to an allocated pension process. There is a limit to how much money you can put into that process, but there is a lot of statistics to say that the majority of Australians stay in accumulated pension schemes for longer than they have to, and they should consider moving to an allocated pension just to get those tax benefits. And the third way you can sort of guarantee yourself an income out of your super fund is to buy an annuity. Now, for those people that don't quite understand how annuities work, they are becoming more common. So typically what happens, you give a lump sum to a life insurance company, in the case whether it's Challenger or AMP, and what they do is they will give you back a fixed annual payment for a number of years. So if you buy, and the numbers typically work out to be, you get about 5 to 6% back per annum. So you put in $100,000 and over 15 years, you'll get $6,000 back as a fixed payment. You can buy annuities that are inflation linked. Obviously you get smaller amounts, but they do move up and down with inflation, so they can grow over time. And certainly Challenger and the AMP also offer lifetime annuities. So they will pay you an annuity until the day you die. What that gives you is certainly it gives you a certain amount of certainty as to how much you'll get and how long you will get that for. So there's obviously benefits. What the downside of annuity is, obviously those payments are relatively small versus what you could earn if you had invested your assets into something else, whether shares or bonds or other investments.